My name is Rohan Reddy. I'm a director of research here at Global X ETFs. At Global X, we manage over $40 billion in assets, and we have presences in New York as well as around the world. As we can see, markets have been volatile to start the year. Major indexes like the S&P 500 and NASDAQ 100 are down this year, with some being down well over double digits. Where does thematic investing fit in today? We see that in a major portfolio allocation, that investors could carve out a certain portion of their portfolio, potentially around 10%, for some of these high-growth thematic investments. We see these as being long-term, mostly in the equities markets, and also very growth-oriented. So what are preferred stocks? Preferreds are hybrid securities with characteristics of both fixed income and equity. Like bonds, preferred stocks are yield-bearing instruments that typically pay a recurring dividend to investors. They're often issued at par value, assign credit ratings, and do not have voting rights. Like common stocks, many preferreds trade daily on a stock exchange and have the opportunity for price appreciation or depreciation. They sit in the middle of the capital structure where they're above common stock in terms of seniority, but below bonds and other fixed income instruments issued by the issuing company. Historically, the yields on preferred stocks is one of its best attributes. Preferred stocks today are yielding around 7%, which is a very high level of income for investors looking for an income tilt within their portfolios. Historically, preferreds have yielded more than even corporate bonds, S&P 500, and even the 10-year Treasury. So the spread on that yield is very attractive. Correlations between preferreds and other asset classes, like those across fixed income and also even equities and alternatives, historically preferreds demonstrated particularly low correlations with traditional fixed income instruments like long-term U.S. Treasuries and investment-grade corporate bonds. Preferreds tend to be issued often by companies in the financial and banking sector, and they're largely issued by regulated banks and regulated insurance companies, meaning that this could be different than the 2008 financial crisis, given that the risk profile of the banking sector has improved significantly with greater reserves and improved balance sheets. Today, we believe that the duration and yield trade-off of preferred stock relative to other fixed income asset classes is one of its best attributes and a very attractive value proposition today. With most fixed income asset classes demonstrating high levels of duration risk at a time when interest rates are rising, and also yields that may not be keeping pace with inflation, we believe that preferreds are a solution for investors to consider. Today, we believe that commodities presents a great opportunity for investors. Despite risks from China and the uncertainty around that market with zero COVID policies affecting growth-focused commodities, the strong dollar and tightened financial conditions, commodities remain a very bright spot in the market as inflationary pressures continue to loom over. In particular, we prefer commodities like uranium, silver, gold, and copper. Uranium is a segment of the market that we like a lot today because of the movement towards green energy and additional nuclear power plant builds across the world, particularly within China. Many countries have either been integrating nuclear power into their energy agendas or have been delaying planned phase-outs, bringing additional demand for uranium to the surface. Another really bright spot of the market is in the copper segment. Copper demand through clean energy initiatives could be a real catalyst for higher secular demand over the long term. Lately, China's zero COVID policy has weighed on copper prices, but when Chinese markets often rally and recover, this lifts the entire copper market. These positive developments that could happen in China could eventually turn out to be a boon for the copper markets. While copper demand through clean energy initiatives could be the catalyst for higher secular demand, the metal could now benefit from the expected Chinese recovery and the current macro backdrop. Copper's positive correlation with rising prices makes it an attractive inflation hedge. The US CPI index reached new highs lately, growing at the fastest pace in more than 40 years. Copper today plays a vital role in the electric vehicle movement. Not only is copper used within vehicle production, but it's also considered a vital commodity for various aspects of EV infrastructure, giving copper a strong growth tilt. According to estimates, the EV sector alone would require 250% of an increase in copper production by 2030. This is because electric vehicles consume nearly 4 times as much copper as internal combustion engine vehicles. Copper plays a vital role in the broader decarbonization efforts. It's used in other applications such as offshore wind, solar panels, and onshore wind farms. Uranium, which is the primary fuel input into nuclear power, is becoming key towards the energy transition. Uranium is a heavy, dense, and radioactive metal, making it a potent source of concentrated energy. Uranium fuel enables nuclear power plants to generate electricity, which in turn can power many of the nuclear power plants that we're seeing pop up in the market today. Nuclear power is one of the few sources of electricity that combines large-scale power output and low greenhouse gas emissions with costs comparable to those of traditional fossil fuel power stations. Nuclear reactors generate electricity by producing immense heat. Ongoing fuel costs for nuclear power plants tend to be quite low, given the minimal amount of uranium needed to power the plant. Nuclear is also amongst the cleanest methods of producing electricity in terms of greenhouse gas emissions. Fossil fuel reductions and aggressive net zero emissions targets by countries around the world are set to keep uranium demand high. Nuclear power as a low carbon emissions energy option is the biggest source of uranium demand globally. Nuclear power emits far less carbon dioxide than traditional fossil fuels, with emissions of just 12 grams of carbon dioxide per kilowatt per hour. Nuclear power emits comparable carbon dioxide emissions to even traditional renewable energy sources like onshore wind, offshore wind, and solar panels. How much power does a nuclear reactor produce? It's nearly the equivalent of 100 million LED light bulbs on a traditional reactor, 431 utility-scale wind turbines, and over 3 million solar panels. Uranium is also proving to be key because nuclear is a reliable and cost-effective source of energy. Nuclear is highly dependable as it operates at full capacity over 93% of the time. From a cost perspective, the average levelized cost of battery storage is 73% more expensive than nuclear, particularly notable given that nuclear power plants achieve almost 3 times greater reliability than wind and solar plants. We're very excited to be able to bring to you innovative solutions at Global X ETFs. Across our thematic, income, and commodities lineup, we believe that today we have many solutions for investors to consider. We thank you for joining today's video from Global X ETFs about the innovative ETF solutions we offer. Thank you.